Live from the Bloomberg New Economy Forum in Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis.
Sales are off the charts. Nvidia GPUs in the cloud is sold out, but we've got a bunch of Blackwells to sell.
Nvidia's surprisingly strong sales forecast soothing fears of a stretched AI valuations, sending Asian stocks higher, even as traders all but wipe out bets on another Fed rate cut this year. Nvidia CEO Jensen Huang telling us he's seeing something very different to a bubble in the AI sector. Hear more from our exclusive interview, including his outlook on China. Plus, more insightful conversations right here at the New Economy Forum. I'll be speaking with the Nasdaq CEO, Adena Friedman, Australia's future fund chief, Raphael, Arndt, Tokio Marine Asset Management CEO, Kazuya Nagasawa, and the founder of Intrepid Growth Partners, Machin. Markets across Asia rallying, with investors breathing a sigh of relief as Nvidia's strong sales forecast eases concerns about an AI bubble. The world's most valuable company jumping more than 5% in late U.S. trading. CEO Jensen Huang spoke exclusively to Bloomberg about Nvidia's booming business and how he hopes to re-engage with the Chinese market.
Sales are off the charts for Blackwell, and Nvidia GPUs in the cloud are sold out. We got plenty of Blackwells to sell you. We have lots of Blackwells coming. We're making a lot of Blackwells, and we have a bunch of Vera Rubins coming. And so business is very, very strong. Nvidia's forecast for China market is 0. We're going to continue to engage the U.S. government, continue to engage the China government to advise them and to encourage them to allow us to go back and compete in the open market. And so until then, we should assume 0.
Nvidia's earnings optimism comes after a tough stretch for the Nasdaq 100 index. The tech benchmark has tumbled almost 4% over the past 2 weeks as investors exited risk assets over those AI valuations. And we have breaking news right here. China weighing new property stimulus package as the crisis drags on. We know that there's been a lot of issues about China's economy, its inability to revive the economy on the back of stresses in the property sector. Now we're hearing from the Chinese government saying that it is weighing new property stimulus package as this crisis weighs on. Taking a look at some of the players in China, Logan Group in positive territory right now, up 0.7%. Not the same story for China Jinmao Holdings. It is in the opposite direction, down 0.7%. We'll continue to track those players. Sunak, China, by the way, surging about 6% as we speak. Again, China weighing new property measures, stimulus measures with mortgage subsidies. Now back to tech. And who better to talk about the AI boom and bubble fears than the person leading the home to many of the world's biggest tech stocks. Our next guest heads Nasdaq, the second largest equities exchange in the U.S., also providing tech infrastructure to more than 130 exchanges worldwide. Adena Friedman is Nasdaq's chair and CEO. Welcome to the show. We're really excited to have you on board.
It's great to be here.
So, a lot of focus on the AI space, and it does seem like Nvidia has eased some of these concerns. How are you reading into the sell-off that we saw recently?
Well, I think first it's important to recognize that the AI revolution and the future of the economy is really going to be driven by this technology. And therefore, if we think about it being in the first batter, the first inning of a baseball game, that's really where we are with the development of the technology and the use of the technology across the economy. But it is new, and it's new, and investors are having to digest the fact that it's new, and they don't, there's going to be some uncertainty as to exactly the path of progress, the path of investment, and these types of signals that you get from the companies that are really leading this revolution are the ones that the investors need to be able to help them understand that it remains on track, it remains something that they feel that they can invest their money behind. And so the earnings that we saw from Nvidia, but also from other major tech, the hyperscalers and other major tech companies, I think are continuing to drive the support for the overall view that this is a great investment to make over the long term. So just an example of just the correlation between the index, the Nasdaq 100 index, and the performance of the companies in the Nasdaq 100 index. Since the beginning of the year, the index is up 17%. That's after the sell-off, so still up 17%. But yet the earnings of the companies that are in the index are up 18%. And so it is very correlated to the actual earnings power of the companies in the index.
But there is basis to be worried about concentration risks. Imagine the whole market just waiting for one company's results to see where it goes from there. How are you assessing the kind of risk, especially when a lot of retail money is in there?
Well, I would look at it more as every company, as they are announcing their earnings, are giving investors an understanding or an indication of the overall trend of this technology and how it will affect the economy. So it's not so much that there is a reason why these big companies are really driving this investment forward, at driving this new technological innovation forward. They have the capital, they have the reach, they have the clientele. They are integrated across every sector, and so therefore, and then the technology, the chip technology and others. That is really going to be such an important underpinning of the infrastructure that's needed in order to drive this technology across every sector. So these are important companies to be able to understand and give indications as to the progression of the technology. But we actually have seen broad-based returns across the markets this year. Up until the sell-off a couple weeks ago, even the small cap markets and the small cap index in the United States was up 12% for the year. The mid cap markets are up in that 12 to 15%. So the markets in general are demonstrating that there's general resiliency in the economy. There is also this great new opportunity to drive productivity, to drive growth across every sector with this technology. And I think that's what's manifesting itself in the markets this year.
And speaking of technology, under your leadership, the Nasdaq has become a technology company. How do you see that driving growth going forward? And, in terms of contribution, what are you looking at?
Yeah, well, thank you. So we have actually really expanded Nasdaq to be an advanced technology company that serves the entire financial system around the world. We have our wonderful markets, and we're so proud of that. And obviously, we're home to great innovators. But we've also provide mission-critical technology to banks, brokers, other central banks, other exchanges. We provide technology to 140 exchanges around the world, including the Singapore Exchange here, as well as 20 central banks. We provide risk management technology and treasury management technology. And we then have anti-financial crime, regulatory reporting, surveillance technology that helps banks manage risk while driving liquidity into the system around the world. And we're really proud of that role that we have to really partner with the banks. And then, of course, we have these great investable products with our index business. So if you really think about the growth of Nasdaq, it's growth through the markets, it's growth through the modernization of infrastructure in the financial system with our technology, and it's growth through these great investable products.
How are you investing into that space, into that business?
Well, we actually are always looking to make sure that we stay ahead of anyone else who could come into the space in terms of how we can drive the modernization of markets, and we can drive and use technology to drive integrity into the system. So we use AI across our anti-financial crime technologies. We're also creating a lot of efficiency for our bank clients through digital workers that we've embedded in the platform, so they can be both efficient and more effective in rooting criminals out of the system. We're driving that kind of automation across our surveillance platform, into our risk management platform. And so AI is going to be our future too. And we're very excited to be able to create new capabilities for our clients to be efficient and more effective in managing their risk in the financial system.
And of course, technology will allow you to do 24/5. Realistically, when can that happen, and how do you see this evolving?
Yeah, in fact, I would say technology is definitely the underpinning of our ability to be able to go to 24/5. We provide market technology to other markets that are already 24/5, 24/7. In fact, we provide technology to crypto exchanges and other futures exchanges. So we're going to use our own capabilities to drive the Nasdaq stock market into a 24/5 environment. And we also are working with the industry because we can do it, but we want the whole industry to feel like this is going to be a better experience than that they have today. Today, there are players out there that provide 24/5 trading for investors, but they don't have the central transparency of the tape. They don't have as much resiliency as markets provide. And what we want to bring is a lot of investor protection into the experience that investors have as they're trading around the world, around the clock. So we're very excited to be able to do that, and we hope to be able to launch that by the end of 2026.
Hey, that's great. And also IPO, make IPO great again. And we know you've just signed an agreement, a partnership with the Singapore Exchange. We spoke earlier to Boon Chai of the Singapore Exchange. Let's take a listen to what he had to say.
Great, thank you.
This pathway together with Nasdaq allows for tech, high-growth companies to tap both the global capital and with the Asian nexus. We're excited. We're getting domestic support. There is going to be more pots of pre-IPO cornerstone that issuers can look forward to.
So expect the tech unicorns. Is that correct?
Yeah, so we have a great relationship with the Singapore Exchange. We've been a 2-decade partner on the technology side, and we have really worked very hard to help them advance their markets. We've had different dual listing programs with them, but this one's special. I mean, this one is different. The most important difference is if you look at it from the point of view of the issuer itself. These great growth companies that are here in Asia, they want to be able to tap the domestic markets here and domestic investors while also tapping global investors in the United States. But today they have to go through 2 different regulatory processes to do that. Under this agreement, MAS and the SEC have come together to say, let's create one experience, one regulatory process to be able to tap 2 markets. It's the first of its kind, and we're very excited to be partnered with the SGX, but also and we've brought the whole ecosystem together. There's investment dollars going to be committed to this through the Singapore investment funds, as well as a regulatory framework that we think is really unique, that is going to make it so that these great tech companies and great growth companies, healthcare, tech, others, will have access to both markets simultaneously.
How much of a boost will it give the Nasdaq versus other IPO markets like, the UK, London, as well as Hong Kong?
Well, we actually see this as a great opportunity for us to differentiate ourselves from everyone, both SGX and Nasdaq, to make it so that we can bring these great Asian companies and companies with a real Asian connection and expose them to the depth and the liquid markets that we have in the United States, the depth of those investors that really understand these companies and can really put their capital behind them, and at the same time enable these companies to be a part of the domestic market, to get access to that great capital that's here in Asia, and do that with one seamless experience. So we're very excited about it. We do think it's differentiated from anything that's out there today.
And as you try to boost the IPO market, of course, President Trump has weighed in. He wants regulations to be eased when it comes to listings. Where are we with that? And what conversations are you having?
Yeah, so making IPOs great again is something that we really care a lot about. And we're very excited because we've been advocating for a lot of the changes that, in fact, the administration has been discussing. And so as we see the opportunity for us to think differently about disclosures, the timing of disclosures, does every company need to have a quarterly report, or can there be semi-annual reports or other reporting regimes that can exist? Is a one-size-fits-all model really the right model for every company listed in the United States? And we don't think that is the case. We think there is an opportunity to be more flexible there. The proxy reform, the fact the administration is weighing in on proxy reform is so exciting, because that is one of the most onerous parts of being a public company today, is managing the proxy process and the lack of oversight that the proxy advisors have from the regulators. So we're very excited to see the opportunity to make some changes there. And then the third area that the SEC is focused on is litigation reform. Allowing companies to file to go public with a mandatory arbitration clause as opposed to subjecting them to class action lawsuits it's an incredible innovation that we hope that the SEC is able to implement.
All right, Adena, great to have you with us. I know you have a hat out. Thank you so much for joining us on Insight. Adena Friedman, Chair and CEO at Nasdaq. Let's do a check on the Chinese property stocks on the back of plans by China to provide that stimulus to the property sector. The stock gauge reversing its drop on that potential stimulus. Currently, we're seeing the index climbing about 1.5%. China weighing in on new property stimulus with mortgage subsidies. Now, still to come, the CEO of Australia's Sovereign Wealth Fund will be joining us exclusively with insights on the market risks around AI, trade disputes, and rising inequality. Much more ahead. Keep it here with us. This is Bloomberg. Welcome back to Inside. Asian markets jumping after Nvidia's strong earnings. Let's get straight to our next guest, who runs Australia's Sovereign Wealth Fund, the Future Fund, as it's known. Reported assets under management as of September of approximately $171 billion. Joining us exclusively is the CEO, Raph. Arndt. Raph, good to have you with us. First off, I just want to get to the breaking news. Bloomberg Scoop suggesting that China is mulling new stimulus for its property sector. That's good news.
Well, of course, China's the second biggest economy in the world, so a stable, growing economy is good for everyone.
So what do you make of this stimulus? Because the property sector has been lackluster, and that's part of the reason why it's been so difficult to reverse the economy and also the market.
I mean, the Chinese economy is going through an adjustment, and it has been since COVID, and the froth has come out of the Chinese property sector, and that's probably appropriate over time, but managing that transition is important. A lot of the Chinese people have investments in property, and the wealth effect has an impact both in China and then on the rest of the world. So managing the economy carefully and steadily is a good thing for sure.
And managing expectations is also another thing. We know that investors have been, waiting for the stimulus for the property sector. Will this be enough to reverse sentiment?
Well, I think everything helps.
What would help sentiment in the U.S. economy? Because I know you're among those who have pulled back from the U.S. market because, you're questioning the exceptionalism of that market.
I wouldn't quite put it that way. I think the US is the biggest economy in the world. It's the deepest capital markets, and they've performed exceptionally for decades. On the other hand, it is by far our biggest exposure. It's almost half of the whole fund. And so for us, it's really about a risk reduction. The new administration, it's been in for coming up to a year, it's changing a lot of the rules, a lot of the things around trade, around capital flows, taxes, immigration, and it's just increasing risk for long-term investments because there's a bit more policy uncertainty. So we think it's prudent to reduce the exposure a little bit in that environment. But
if you reduce your exposure in the US, where are you adding your exposure?
Well, that's the challenge, and a lot of people say there's nowhere to go, so I'll stay in the US. I think from our point of view, we're very interested in Japan. Yes, the valuations have increased, but there's a lot of interesting things happening there. Europe, I think, is picking up fiscal stimulus. In particular, Germany has a lot of policies, and actually Australia is a pretty attractive case to invest. So from our point of view, we're bringing money home.
Let's unpack that, and I want to start with Japan. There are concerns about the stimulus package, perhaps a government that is willing to spend more than people would like. Would that perhaps impact the way you look at the market?
Well, if you take a step back, Japan's really been delevering since the bust in 1990, and it's reached the end of that cycle. So the corporates are now delevered, the households are delevered, and they're ready to start to take some equity risk again. And we've seen that put supply into the equity markets. Interest rates have started to improve. Inflation's come back. As long as that can be managed, all of that's a good thing in the long run. So yes, there'll be bumps and adjustments along the way, but the broad trend here is that there's a lot of Japanese savings. Those savings are starting to come home, and they're starting to be invested in riskier assets. That's good for Japan, and that's good for the market.
So what's attractive in Japan?
Well, we're seeing it across a lot of things, not just the market, but Private equity, there's some specific private equity strategies in Japan. Actually, we've started active Japanese equity strategies because not all the companies are run for the shareholders as well as they should be, but some are, and increasingly they are. And even in things like real estate and credit, there are interesting things to do.
And realistically, what kind of returns can you expect from a market like Japan?
We're looking for the same returns as we are everywhere else in the world. And in the areas we're investing in, we're getting those.
And you talked about bringing money back home. What is looking attractive in Australia?
So the ASX is certainly on the expensive side, but Australian infrastructure, private credit, real estate has bottomed and is starting to improve, and even private equity, there's a growing venture capital industry in Australia. All of that looks really interesting to us.
But isn't private equity a crowded space now? There's growing concern that it is.
Well, in Australia, it's the banks that fund most small and medium businesses, and that's very increasingly hard for them based on the regulatory capital system. So other forms of financing of growing businesses actually helps the whole economy grow, and there's a lot of opportunity.
If you take a step back and look at the private space as a whole, of course, there are concerns around private credit. We heard from Good Luck expressing such concern. Do you share that view that Good Luck has expressed?
I don't have a concern that there's a bubble in private credit or that it's going to blow and it's going to be a systemic risk. We do quite a lot of private credit. I think private credit is for sure good for the economy because banks are much more levered than private lenders, and there's more financing available for companies to grow. But you need to have strong credit skills and you don't want to levy your portfolio. So the way we invest in that is through very strong credit-focused investment managers. Those sort of investments will be fine. But I do think there's a case for regulators to look at some of the outlier actors who are leveraging their portfolios, take undue risk and are largely selling to retail investors.
What signs are you looking out for before you start worrying the way Good Luck is worrying?
Well, I don't think we can predict a correction. We don't pretend we can. So I think we're talking about building resilience into our portfolio, and we in fact put out a discussion paper on that earlier this week. There's so many uncertainties in the world right now because of the geopolitics, more populist politicians. Everything can turn on a dime and we can't predict it. And so really we're thinking deeply about what are the wide range of scenarios that might happen, what would happen to our portfolio in each of those scenarios, and do we want to make adjustments? And I think every investor and really every business has to think about an uncertain future and how they can manage all the different paths that might arise.
Rav, in our conversation so far, I've not heard India and I've not heard AI. Why is that?
Well, we're certainly a fan of AI. Is there a bubble? Well, maybe in some parts of the ecosystem, but it is going to change the world. We do a lot of early stage venture investing, and based on what I see our portfolio companies doing, it's coming quicker and in a more impactful way than most people think. I think it will help corporate margins, but it will also help deliver better services to the average person, especially in areas like healthcare and education, areas where we struggle to get enough teachers. India is an important place. It's a growing economy. We keep a close eye on it. We have quite a lot of investments there, but they need to deepen their capital markets and deregulate if they want to hold themselves up to attract capital along with these big financial market centres that I've been talking about.
Before we let you go, we had numbers from Nvidia just shortly. I'm just wondering how you view concentration risks, given that all eyes were on Nvidia to dictate where the market goes from here.
Well, I think history tells us that when you have a single dominant company, eventually they get disrupted. Sometimes they disrupt themselves, and let's hope that they do that for their shareholders. From our point of view, we want to spread our bets, so we do think about concentration risk, but we don't think about that just in terms of the US equity market or even the equity market. We're looking across the whole portfolio.
Right.
And so we have a pretty manageable exposure to any individual company, including Nvidia.
Raph, it's been great having you. Raph Arndt, CEO at Future Fund. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight live at the Bloomberg New Economy Forum in Singapore. Let's do a check on an index of Chinese property stocks now. That gauge jumping after Bloomberg reported that China is considering new measures to turn around its struggling property market. Let's get more from our chief North Asia correspondent, Stephen Angle in Hong Kong. Steve, that's fantastic news.
Yeah, I mean, the property woes, it's now into its fourth or well past its fourth year, into its fifth year, really. And it is at the heart of all the big issues in the Chinese economy, whether it's persistent deflation, lack of consumption. It is all tied to, of course, households feeling their wealth effect has deteriorated over the last half decade. So again, there's been a rising chorus of calls for increased and more forceful property measures. And according to sources are saying that the authorities, while they haven't finalized the details, are coming up with a number of different scenarios, including what you're seeing on your screen, basically providing potentially new home buyers mortgage subsidies for the first time, also raising income tax rebates for mortgage borrowers and lowering home transaction costs. Keep in mind, there have been a number of steps, in particular in the Tier 1 cities of Beijing, Shanghai, and Shenzhen, of easing multiple purchases and also, of course, some of the lowering of loan thresholds back in August. It simply hasn't rekindled interest in the property sector. So again, as I said, more forceful policy support is being called for. And it looks as though authorities, including the housing ministry and other authorities, are looking at a number of different plans. Timing and specifics of those proposals are not known. So again, we can't put a lot of meat on it other than to say the plan has been in discussion since the third quarter and seems to be gathering some speed.
The question is, will it be enough, and how big they need to be, given that we've seen a slump of about 4 years?
Yeah, that's right. So, we have to look at Bloomberg Intelligence. Their take is they're talking about hundreds of billions of yuan in negative equity, a trend that is likely to be accelerating into 2026. That's going to put more pressure on the banks, obviously, and it's going to lead to, some serious questions about bondholders and their repayment values, of course. This is what Bloomberg Intelligence says. Hundreds of billions of yuan of mortgages are likely in negative equity right now, a trend that is likely to intensify, which will weigh on buyers' confidence and contribute to further home sales decline. So again, the threatening of the destabilization of the financial system is probably the number one and the paramount concern of authorities right now as they head into 2026. Keep in mind, we've just had closed-door meetings in the last couple of weeks by the top policymakers as they're coming up with the next 5-year plan that will also likely come to light at the National People's Congress in March. So these plans are probably coming forward and will materialize in the coming months. But a lot of people that we've spoken to say there might be even more urgency that some of these policies need to come out before the NPC meets in the first part of March.
As you said, no sense of the timing of such measures, but it is critical. Timing is critical.
Yep. Absolutely it is. And that's why these calls are growing in earnest and in seriousness, because, again, it goes back to the financial viability and whether the rise in non-performing loans. You have all those so many of these households are sitting on negative equity because of their household wealth, upwards of 60% of household wealth tied to property. And that's going to see some significant impact on the balance sheet and the loan portfolios of the nation's financial system.
Stephen Angle, thank you so much for your insights. Bloomberg Stephen Angle in Hong Kong. Let's do a quick check on where the markets stand in terms of those property plays in China on the back of that scoop from Bloomberg suggesting that China is mulling new measures to prop up its property sector. Taking a look at where the CSI 300 index is right now, it is trading up by 0.3%, though it is a positive day for the markets. And we have breaking news right here where White House officials are urging members of Congress to oppose a measure that would limit Nvidia's ability to sell AI chips to China and other adversary nations. And that's according to people familiar with the matter. Again, the White House officials urging members of Congress to oppose a measure that would limit Nvidia's ability to sell AI chips to China and other adversary nations. Taking a look at how chip stocks are reaction, of course, we're also bearing in mind the numbers from Nvidia that's been propping up chip shares in Asia. TSMC leading the pack higher, up about 4% right now. We have SK Hynix also in positive territory. Of course, all eyes had been on Nvidia to see whether or not the AI rally is sustainable. On the back of that, again, the breaking news that we have right now, the U.S. lawmakers mulling a new bill to codify China AI chip export curbs. Now, speaking of Nvidia, its strong revenue forecast for the current period is helping counter concerns that a global surge in AI spending is poised to crash. But CEO Jensen Huang told us that Chinese sales are not included in the outlook because of U.S. restrictions. He spoke exclusively to Bloomberg about seeking to re-engage with China and the upbeat forecast.
Sales are off the charts for Blackwell, and Nvidia GPUs in the cloud are sold out. We got plenty of Blackwells to sell you. We have lots of Blackwells coming. We're making a lot of Blackwells, and we have a bunch of Vera Rubins coming. And so business is very, very strong, but we've planned our supply chain incredibly well. We have the largest supply chain in the world. Our partners, TSMC, our memory partners, SK Hynix, Micron, Samsung, are doing a fantastic job supporting us. And all of our systems partners, Foxconn and Quanta and Wistron, our packaging partners, everybody's doing a fantastic job supporting us. And we've done a good job planning for a very, very strong year. And we've done a good job planning for Vera Rubin. So sales are off the charts. Nvidia GPUs in the cloud is sold out, but we've got a bunch of Blackwells to sell.
Jensen, what's the road ahead for Vera Rubin? It's one of the most common questions we get for you of how that ramp will go relative to what we saw with the Blackwell generations.
Well, the silicon for Vera Rubin, 7 different chips are back in our labs. And the bring up is happening across engineering teams. Probably a couple of 20,000 people are working on bringing up Vera Rubin, from silicon to systems to software to algorithms. People are working around the clock, and this bring up is going beautifully. We're on track to deliver Vera Rubin about Q3 timeframe of next year, continuing our once a year cycle. Vera Rubin is already assured a huge success. Everybody's incredibly excited about it. Can't wait to show everybody. And then one last thing is that the rack architecture, the rack scale architecture is completely revolutionary. It includes a scale up switch called the NVLink. NVLink 72, our 5th generation, is the only one of its kind in the world. This rack architecture, which is incredibly complex, started with Grace Blackwell, then Grace Blackwell Ultra. It is transition to Grace Blackwell Ultra is incredibly seamless. The same rack scale architecture is going to be used for Vera Rubin. And so the supply chain is all used to it. This complexity that we enjoyed with Grace Blackwell transition, we're now incredibly smooth running. And so I think Vera Rubin's going to be just really smooth, and we're going to ramp it really hard.
Jensen, I tried to go through what the CFO Colette Kress said about China. In the quarter gone, it seemed like there was not meaningful H20 sales because the demand wasn't there, even if you were permitted to sell H20. And then in the current period and going forward, Nvidia seems committed to working with both the United States and China to sell what Colette called more competitive compute. Where do we stand with that? And could you just clarify what Colette was talking about in the current state of play for China?
The most important thing she said is that we've said for some time now, our forecast for China is 0. All of our forecast guidance that we showed, 0. we should start. That's the most important thing that she said. She also said that effectively China is a very important market to us. It's very important to the United States. It's very important to China. We would love the opportunity to be able to re-engage the Chinese market with excellent products that we deliver and to be able to compete globally. The Chinese market is very large. This year, my guess is probably about $50 billion. It's great for the American people that we're able to compete in the Chinese market. It's great for the China market that we're able to provide NVIDIA's technology to them. It's great for the rest of the world as Chinese software companies and Chinese open source models leave China and are used all over the world. And so I think it's fantastic that it would be fantastic if we're able to participate in the China market. But for now, we should just assume our NVIDIA's forecast for China market is 0. We're going to continue to engage the U.S. government, continue to engage the China government to advise them and to encourage them to allow us to go back and compete in the open market. And so until then, we should assume 0.
Nvidia CEO Jensen Huang speaking exclusively to Bloomberg Tech anchor Ed Ludlow. Just a recap of the breaking news that we just had. The White House asking Congress to reject a bill curbing NVIDIA exports. We have the GAIN Act. That would create a system that requires chip makers to give U.S. companies first dibs on AI chips that are controlled for export to China and other arms embargoed countries. In terms of the reaction in the market, of course, bearing in mind the numbers out of NVIDIA providing that support for chip makers, TSMC currently up by more than 4%. Take a look at EBITDA, currently surging by more than 9%. Now, let's take you live to the Bloomberg New Economy Forum, where our own Francine Lacroix is leading a panel discussion on the risks of record global debt and higher rates.
Led to a lot of US dollar related fluctuations, which I think many of the governments in Asia are also trying to grapple with as well.
John, do we actually get to a tipping point? How do we know when we're at a tipping point, for example, for the US? Mark's laughing over there because he knows the tipping point.
John knows it. I think to level set this, just to remind us all, if we even look at let's start with the G7, we're at the same level of debt that we were at the end of World War II. From a global point of view. And the reason for that is, of course, the world took on a lot of debt. It was very expensive following the global financial crisis in 2008 and then subsequently the pandemic in the late teens. I think this is a chronic problem. I don't think it's an acute problem. I think, the forest is smoldering. But we're not at the edge of the cliff. I think what we need to keep in mind is, and I have commented to Bloomberg that I thought that the title of this panel was a bit dodgy and that it was just debt sustainability. It actually should be debt sustainability and the global social contract, because what this is all about is governments around the world have a social contract, particularly in the developed world. And Mark and I were talking about it's emerging in some parts of the emerging markets where populations are aging, people are expecting pension, healthcare costs, and the uncertainty of AI and how that's going to affect all these things are causing governments to have more expensive programs. And we look at the G7, more than 60% of annual budgets are entitlements. Oh. And I think this word entitlements, it's one of those words that politicians don't like because it's like handcuffs. We can't do anything about entitlements. It's pensions, it's health care, and it's other type of social welfare benefits. But the reality is those have to be thought about in the context of how they're paid for. And it's interesting, Francine, we're here in Singapore where you've got this extraordinary model of having a government that set aside a very large amount of capital that has become, I think, 20% of their annual income as a result of having a sovereign wealth fund. So this is actually a very good test case for prudent fiscal management.
So there's a QR code if you want to ask questions. Then I also am going to put all of the audience to work because I have a polling question. But first, there's a first QR code for questions. Lim Hui Hua, do you agree with what John was saying?
Yes. Well, I think it comes really, well, I mean, it's not just the US. A lot of countries have taken on increasingly more debt. So it comes really at the expense of long-term infrastructure development, healthcare, education, defense, and welfare benefits as well. Yeah.
So to the polling question, because that kind of puts everything into context, although I will ask Mark where you see the tipping point for U.S. debt and what you're monitoring. But this is a polling question. So what's the most realistic way? There you go. This is a QR code. What's the most realistic way to break the cycle of runaway debts? And again, this kind of goes back to the idea that John was talking about for the social contract. So A, spending cuts on social programs, not very popular. And I know it's politics that is driving economics, but not popular. Major tax increases. B, also not very popular politically. C, legally binding budget caps. We may talk about the UK. And then D, investing in growth and productivity. So whilst everyone is voting on that, Mark, if we just quickly, briefly go back to U.S. debt, how do you monitor something happening on U.S. debt? Like, when do we know we're close to a tipping point?
The markets will tell you. I mean, if you think about what happened in April, there was a moment when the curve didn't behave quite like it should do, when there was a risk-off moment. There wasn't enormous amounts of buying at the long end. It didn't react exactly how everybody expected. And that's telling you that the markets were much happier staying in the short end, thank you very much, and looking to apply their capital when they felt other things were being managed. So the markets will be the first thing that tells you. And it's generally the markets that hold governments to account. For economies that are based on running deficits and having market access, if there's a hint of no market access, things tend to happen. Yeah. And it changes governments. You saw it even happen in the UK.
And the US, I mean, the Treasury auctions are still functioning in a very stable, if not robust way. So the U.S. government's access to finance is still very strong. I agree with Mark, but I would also say that you have to couple that with the word confidence of government. The markets pay attention to leadership and confidence from the, whether it's the
Coming up, India takes the spotlight at day 2 of the Bloomberg New Economy Forum as we unpack the outlook for its growth and global trade ties. Keep it here with us. This is Bloomberg. White House officials are urging members of Congress to oppose a measure that would limit Nvidia's ability to sell AI chips to China and other adversary nations. Bloomberg New Economy editorial director Eric Schatzker joins us now. I mean, this is exactly what they've been discussing here at the New Economy Forum.
It certainly is. And this really cuts to the core, Haslinda, of the competition for technological supremacy between the United States and China. China is absolutely catching up in areas like large language models for artificial intelligence, but where the United States still has a clear-cut lead is in semiconductor architecture and manufacturing with the help of America's partner in Taiwan, specifically TSMC. That's who makes the chips for Nvidia. Right now, the Chinese are not allowed to buy the most advanced, cutting-edge, American-designed, Taiwanese-manufactured Nvidia chips. Why? Because not all of the United States, clearly, but there are significant parts of the U.S. government infrastructure, including largely Congress, that have concerns about dual-use technology. If America were to allow China to buy these chips from Nvidia, what would China do with them? Would they be used for commercial purposes? Would they be used for social purposes? And those social purposes could include surveillance. Or would they be used for military purposes, contrary ultimately to the interests of the United States. This is one of the single biggest geopolitical disputes, areas of conflict. And what's fascinating about it is that you have the White House on the one side urging Congress to allow Nvidia to sell these chips to China, and members of Congress being very resistant.
This tech race is really interesting. If you had what the Singapore Prime Minister said yesterday, only China can stop China, and presumably that includes the tech space as well.
That's a very charitable view. Ultimately, it's not wrong to imagine that China will be every bit as good in semiconductor design and manufacturing as, again, the America-Taiwan partnership, epitomized by Nvidia. But that day isn't now. And so what's the incentive? That's the question that Congress is wrestling with, and which the White House hasn't made clear. What's the incentive for allowing Nvidia to sell these chips to China? Is it truly in America's interest? Or is it only in Nvidia's interest? Or, unfortunately, this White House has left us also asking the question, is there a side deal that we aren't being told about?
And of course, we've had the likes of Gina Raimondo weighing in on it, even Robert Lighthizer in my conversation with him some time ago. Now, in the tech space, India is trying to be part of the T3. You've had a conversation with Indian Minister Vaishnaw. Let's take a listen to what he had to say.
Today, we already have an ecosystem developing just in 3.5 years, where production of chips is starting, design of some of the most complex chips is now happening in India. By 2031, 2032, in that time frame will be equivalent to what many of these countries are at today, and then it will be a race which will be a very fair and a level playing field.
Pretty big ambitions. It wants to be on par with the other big chip makers by 2032. It has a long way to catch up.
He has a long way to go. And I made that very clear with the minister when we were talking that where India is today relative to the ambitions that he outlined there, there's a big gap in between. It's fine to be ambitious. And it's also important to understand or to unpack what the minister said. Right now, it's true, India is a force in semiconductor design. And with 1.4 billion people and let's call it a tech education ecosystem, the India Institutes of Technology, unrivaled by any country anywhere else in the world, there's every reason to believe that India can, in a number of years, be on par with what you get out of China or out of Taiwan or out of the United States or out of certain parts of Europe. But will India be able to manufacture on the same level? There is not a single country in the world that can manufacture at scale at the most advanced semiconductor architecture at the moment, 2 nanometers. Taiwan is the only one that can do it. The Americans are struggling to get there right now. Look at all the troubles that Intel is having. TSMC, the giant Taiwanese manufacturer, is building fabs in America, and even those fabs aren't going to manufacture at 2 nanometers.
We have to leave it there. Eric, thank you. Eric Shetzka, Editorial Director of the Bloomberg New Economy Forum here in the Lion City. Much more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight live at the Bloomberg New Economy Forum in Singapore. Now, markets across Asia are rallying, with investors breathing a sigh of relief as Nvidia's strong sales forecast eases concerns over an AI bubble. The world's most valuable company jumping more than 5% in late U.S. trading. CEO Jensen Huang spoke exclusively to Bloomberg about Nvidia's hopes to re-engage with a critical Chinese market.
Nvidia's forecast for China market is 0. We're going to continue to engage the U.S. government, continue to engage the China government to advise them and to encourage them to allow us to go back and compete in the open market. And so until then, we should assume zero.
And Bloomberg has learned that White House officials are urging members of Congress to oppose a measure that would limit Nvidia's ability to sell AI chips to China. Our tech correspondent, Annabelle Drulis, has more on this scoop. And Belle, that's a positive piece of news for Nvidia.
Yeah, it might be something they like, except it doesn't mean, of course, that it's the end of any sort of bipartisan support to really push back and continue to limit China's advancements in AI. But yes, this is a really great scoop that's come through in the last few minutes here. And what sources are telling us is that White House officials are urging members of Congress to oppose or reject the so-called GAIN AI Act. Now, this is a system essentially that requires chip makers to give US companies first dibs on AI chips that are controlled for export to China and other arms embargoed nations as well. So effectively, it's looking at ways to basically bar AMD, Nvidia from selling their best contracts or best chips rather to China. So that's what is being proposed by White House officials to members of Congress. Again, as I said, yes, that does mean it's a victory for Nvidia. We know that Nvidia has publicly lobbied against this sort of legislation. Their key argument is essentially if you restrict China's advancements in AI, you only push it to become more competitive internally and to continue that focus on self-sufficiency. But as I said, it doesn't mean the end of any sort of pushback or further limitations of China, because what we're also understanding is that lawmakers have begun working on a separate measure. This is called the so-called SAFE Act of 2025. And again, that would require the Commerce Department to deny all application for sales to China of any AI chips that are more powerful than what the US currently allows. So yes, and of course, we just heard there Jensen Huang talking about sales of H20 and how they've had to basically completely clear out China at all from their upcoming revenue forecasts.
Speaking of that revenue forecast, it is that forecast that's driving market sentiment today. It beat expectations.
Yeah, I mean, there was a lot of pressure on Jensen Huang coming into these numbers, and could he deliver something strong enough to try and offset these persistent fears we've seen around the sustainability of AI spending and these concerns that we're in an AI bubble. But actually, he managed to deliver in the late trading session, because we saw Nvidia jumping pretty strongly after the company lifted its sales forecast for the next quarter. So they're now looking at around $65 billion in revenue. They've also said that Blackwell sales are off the charts. They're saying that the ramp up of the Rubin architecture is going very well. There was a weak spot probably, and that was in the margins, and they just missed on analyst expectations. And Jensen Huang also spoke about this, just the pressures in the supply chain, how supply chain component prices are increasing. We had reporting from Reuters, for instance, recently that Samsung was looking to raise a key memory chip price of the DDR5 by some 60% in November alone. So perhaps some of its biggest suppliers, a lot of them based here in Asia, TSMC, Hon Hai, Samsung, SK Hynix, there's a lot more. Ibiden, Advantest, Tokyo Electron. I mean, there's many, but maybe they're looking to take advantage of their pricing power as well.
Belle, thank you so much for that. Annabelle Drulis is there. Now, Nvidia's strong results helping to lift Japanese markets as well, pulling stocks out of a 4-day losing streak. The Nikkei 225 climbing above the 50,000 level. Tech names leading the gains, with SoftBank surging along with chip gear makers, Tokyo Electron, as well as Ibiden. Now let's get to our guest who runs Tokio Marine Asset Management, the investment arm of Tokio Marine Holdings. It ranks among Japan's largest money managers, with approximately $66 billion in assets. Joining us exclusively is the CEO, Kazuya Nagasawa. Kazuya, good to have you with us. It seems like there's been a reversal of fortune for Japan. A lot of funds are putting their money into Japan. Is that sustainable? Do you see further upside from here?
Yes. We are seeing a lot of upside, and this is decomposed into 3 money flows. Many global investors investing into Japan, many Japanese investors investing into Japanese assets, and also Japanese investors investing in the global assets. So this will be contributing to the global capital flow for more growth.
Isn't it true, though, it is the foreign funds that's driving this growth? Foreign funds have been putting money into Japan.
Of course, it is one of the drivers, but the key driver is economic reform and the mindset of the executives or managers of Japanese corporations. So this is not just the money flow from international investors. This is more evolution of the company management in Japan.
How much more upside do you think is there for the Nikkei?
Yeah, it's really difficult question, but in the past few years, it grow or increase the price around 15% per year. And of course, we cannot say 15 years every year going forward, but it will be double digit or higher single digit, depending on the short-term interest rate.
If you were to hazard a guess, though, what would it be? If you were to make a guess how much it will grow, how much more upside for the Nikkei from here, what would it be? Is there a number? Yes.
What will be a time horizon?
Maybe in the next 12 months.
Next 12 months, wow, okay. Yeah, maybe, okay, let me be very bullish, 60,000.
Of course, there are some concerns, and that has to do with spending plans from Takaichi government. Will that weigh on sentiment in Japan?
Yeah, it will. It is impacting a lot, sentiment and actual economy a lot. So basically, we need to consider equity market, fixed income market, and FX market a little bit separately. Of course, we know those are interactions. Equity market, Ms. Takaichi, so Prime Minister Takaichi's expansive budget helps a lot. So that's why I'm really bullish. Fixed income, sometimes people concern about the fiscal concerns. But when we consider the interest rate, now 10-year government bond 1.75%, 30-year 3.3%, this is still a little bit lower than the potential. So this means FX market interest rate will increase, but it is not just based on the fiscal concern. My guess is still market is exploring where is the equilibrium for those interest rates. And FX, this is really different from Mr. Abe or Prime Minister Abe's Abenomics. Abenomics has a clear intention to drive Japanese yen depreciation. But for this government, doesn't have such kind of clear intention. This means even Japanese yen hit 157 Japanese yen per dollar or so, it is still within a fluctuation, usual fluctuation. Usually Japanese yen, US dollar FX rate have 10% volatility, so I believe this is something. And if you are the investor in Japan, actually current depreciation Japanese yen is not the matter. You invest in the market 3 years, 5 years, 10 years. For this long term, Japanese yen may be more likely to be appreciated rather than depreciated.
So as it stands now, forget about intervention in the yen, even though we're seeing a lot of weakness in the currency. Is that a fair assumption?
Yes. Currency intervention may impact on the short term, but from long-term investor, it's not.
And in terms of the bond market, of course, all eyes on what the BOJ does. What expectations are there for a rate hike? Will we see one this year, next year? What are you anticipating?
So, of course, they have their policy, but those policies will be impacted more actual economies. So it will be gradual increase in a short-term interest rate.
What are the risks that the market might be disappointed by a lack of action from the BOJ?
I think it is the speed of the interest rate increase. And actually, already, market are a little bit disappointed. But that's the most or highest risk or uncertainty.
I want to take a look at the performance of your parent company, Tokio Marine. We've seen it slump 8% on the back of disappointing results. Can you reverse sentiment? What would it take to have the stock perform better?
So let me talk a little bit about insurance industry globally. Basically, insurance industry globally seeing significant upside because of course, insurance needs, but this is amplified by climate change. There are a lot of people who want to have more insurance. There are a lot of enterprises which want to have more insurance. So basically, for the next 5 years, 10 years, fundamentals for insurance business is very great. And for Tokio Marine Holdings, this is not my company. This is my group.
Yes.
But basically, our top line revenue, 50% of top line revenue comes from international business. So Tokio Marine have a really good point or positioning to capture or capitalize on the growth of the global industry. And we have new CEO, Group CEO, Koike-san. This June, he will make significant evolution in the company. That's my guess.
So the stock price is not quite reflecting the potential of the business. Is that correct?
Yes. It is something like that, just a reflection of the current past 3 years, really high performing of the stock price. But long term, even mid term, we are so bullish about the Tokio Marine Holdings.
There are a lot of uncertainties in the market right now. What's the biggest risk for your business?
My business. So my business is capitalized on the global capital market. And then Japan market is one of the core business we have. And Japanese economy is one of the high beta country among global countries. So if there is a slowing down in US, it is the biggest risk.
And in terms of where money should be placed in the Japanese market, where should it be? Where's the best potential? What's the biggest opportunity in Japan?
So people can think some themes like AI or defense industry, but more important perspectives when you invest more in Japanese market, it is company reform. How much extent the management can diversify or sometimes concentrate to enhance their business model. This is sometimes M&A, sometimes restructuring. And also, how much extent company executives care about ROE, return on investment, cost of capital. This is more impactful force for company performance.
A lot of questions about wages and inflation as well. How big are these considerations for investors?
That's all good. That's all good. We don't expect those inflation becomes too much. Some slight actually inflation is a catalyst for activating the economy, company's performance.
Kazu, great to have you with us. Come back soon.
Thank you.
Kazuya Nagasawa, CEO at Tokio Marine Asset Management. Now, still to come, an exclusive interview with Intrepid Growth Partners founder Mark Machin. We'll dig into the outlook for AI investment after Nvidia's earnings beat. Keep it here with us. This is Bloomberg.
Sales are off the charts for Blackwell, and Nvidia GPUs in the cloud are sold out. We got plenty of Blackwells to sell you. We have lots of Blackwells coming. We're making a lot of Blackwells, and we have a bunch of Vera Rubins coming. And so business is very, very strong.
Nvidia CEO Jensen Huang speaking with us exclusively after the company's sales outlook for this quarter beat expectations. Well, it founded in 2023 and headquartered in Toronto, Intrepid Growth Partners is a growth equity platform focused on AI-driven investments. Joining us exclusively is Intrepid co-founder and managing partner Mark Machin. Good to have you with us.
Great to be here.
We just heard from Nvidia's CEO Jensen Huang, all excited about the numbers, and obviously the market's excited as well. Is there a sense that we're underpricing risk in this AI space?
Well, I think Nvidia is absolutely the center of this and a major beneficiary. I mean, they are the supplier of the key components of the AI factories. So from their perspective, they are doing extraordinarily well at maintaining their edge, going up and down the stack, creating. So they're not just producing chips, but they're trying to get into more of the application layers as well. And so they're a spectacular company and beneficiary. When it comes to risk, there's lots of risks. And there's risks on the valuation front, there's risks on the leverage front, the amount of leverage that's getting pushed into the system. And there's possibly risks in terms of technology and technology change over time.
And there's such a thing as too much leverage, too much risk. Do you get a sense that we're seeing it in this space? Yes, Nvidia is doing well, but it doesn't mean that everybody else has to come along.
Yeah, so I think the competition for Nvidia is other chip manufacturers. And so there's certainly competition from AMD. There'll be competition from Google producing its own chips, TPUs. There's competition from other, Intel and others. But Nvidia is managing to maintain a very significant edge in terms of the quality of its products and development. I think that will continue. I think where the risks are away from Nvidia, it's further up. It's the builders of the factories, the massive building of data centers. And data centers themselves are big boxes with energy supply, water supply, a lot of other components in there. There's a lot of leverage starting to creep into the building of those data centers, and at different levels, whether at project level, SPV level, at different layers at the company level. And I think that's what people are keeping a keen eye on, is how much of the growth is being funded by debt, which may be fine over time. There's a lot of cash flow that's coming out of them, but over time, that's where risk can be a big problem, where if there's a downturn in pricing at some point, or step change in pricing, then it's the debt holders that will get hurt.
So what I'm hearing is that it is too soon to be talking about the bubble busting.
Yeah, I think that's right. I don't think anything will happen tomorrow. I think that over time, the question is whether the growth can be sustained in demand. I'm obviously an optimist. I'm investing in application layer companies, so I'm optimistic about adoption of AI over time, and that it's going to become more and more widespread. But I think there are risks if you are entirely concentrated on building for one type of architecture of AI, and everything in your factory is designed and optimized just for that. It's possible there could be some, I think it's sort of 15–20% chance that there could be a step change in architecture that results in a reduction in the need for that brute force compute for every unit of intelligence. So that could cause a step change in pricing at some point in time. That's one risk to keep an eye on. And there's a risk that there could be just a slowdown in growth for some period of time, which then causes a reduction in demand, or just huge amounts of supply that causes a reduction in demand, in the ability to keep prices competitively high. So all of those things could lead into reduction in pricing in the data centers, particularly if you've got speculative data centers. Right. You haven't got contracts locked in for a long period of time. And that could then result in challenges for people who hold the equity in these data centers, when obviously the debt holders will be further up the capital stack, more likely to have their capital preserved. But if you're in the equity, you're going to get hurt.
Mark, talk to us about how you're invested in AI and what's the strategy there? Yeah,
so my strategy is, my view is that over time, the profitability will go up the stack. It's happened in every other way, whether it was mobile or cloud or any other shift. And so the application layer is where we're investing. And we're investing in companies that are using AI, using these foundation models, using these data centers to solve real business problems. And that could be a problem, for example, in advertising. So we've invested in a company called StackAdapt, which is the leader for small and medium businesses in advertising, programmatic advertising in North America. It could be in healthcare. So we've invested in a company called Skin Analytics that is the leader for skin cancer diagnosis. It could be in mechanical design collaboration software. We've just announced an investment in a company called Colab that is the leader in collaboration for complicated design teams to visualize components, for example, aircraft components or automotive components, and predict where the problems could be in manufacturing those components. So there's a myriad of ways that you can use AI to better solve real-world business problems. And we're focused on companies that are solving these problems, solving them efficiently, better, faster, cheaper, and doing it in a way that creates real value for the end customer. And we're focused on the unit economics of that value creation. Is it better? Is it increased revenue? Is it reduced cost? There's a lot of reduction of cost, but even better, increasing the revenue for the end customer.
Faster, better, cheaper. It does seem you'll find those companies in China. Do you?
Yes, but I'm not investing in China.
Why not?
Because there's a bifurcation of the world. It's difficult to invest in advanced technologies in China and in the rest of the world. Sadly, the world has changed, so it's difficult to do that. You've got to keep a keen eye on where that competition could come from China. I think, as Jensen Huang's mentioned, 50–60% of the world's top AI researchers are in China. They're going to keep innovating. They're going to keep producing, extraordinarily interesting products. And so you've got to keep a keen eye on what might come out of China to disrupt your product. But I'm not investing there. I'm investing in North America and Europe. We've actually got a little bit of a tilt towards, away from the valley to elsewhere in North America, whether elsewhere in the US or Canada or UK and Europe, where there's a little less frenzy and competition for each opportunity.
Sticking with AI, we know that the debate right here at the New Economy Forum is who's going to win the AI race. Do you have a view on that? Is it going to be China? Would it be the US?
I think, well, one thing I remind people when people ask who's going to win the race, if you remember a few years ago, the race was who's going to win the 5G race. You tell me today who won the 5G race. I mean, that was the big question. Probably if we were sitting here 5–6 years ago, be the question. And I'm not sure who won the 5G race at the moment. So I think it becomes dispersed. It becomes part of everyday life. We have 5G on our phones. We use it all the time.
So is it a matter of framing the AI tech race? How would you reframe it?
I think so. I mean, I think there will be winners everywhere. I think China's going to produce competitive foundation models, which they continue to do, open source models. There will be an increasing amount of adoption within China. There'll be countries around the world that will use Chinese software and software products and hardware products. I think the US has an edge, particularly on hardware and compute. So I think it's very hard for China to catch up on the semiconductor side, particularly without advanced lithography equipment. It's very hard for them to get past 7-nanometer node. So I think that they're going to have to continue to innovate with a reduced edge of compute capability. But they will do that. I think the framing around, who's going to win AGI, I think is years off before we reach true AGI. I don't think that's going to happen tomorrow. And so I don't think the question is who's going to reach AGI first is a good framing.
Okay. Mark, thank you. Thanks for joining us.
Thank you so much.
Mark Machin, co-founder and managing partner at Intrepid Growth Partners. Still to come. Our exclusive with Nvidia CEO Jensen Huang as he dismisses AI bubble worries and tells us he wants to re-engage with China. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight live at the Bloomberg New Economy Forum in Singapore. Now, Bloomberg has learned that White House officials are urging members of Congress to reject a measure that would limit Nvidia's ability to sell AI chips to China. Speaking to us earlier following earnings, CEO Jensen Huang said Chinese sales are not included in their outlook because of U.S. restrictions. He also spoke about the company's upbeat forecast.
Sales are off the charts for Blackwell, and Nvidia GPUs in the cloud are sold out. We got plenty of Blackwells to sell you. We have lots of Blackwells coming. We're making a lot of Blackwells, and we have a bunch of Vera Rubins coming. And so business is very, very strong, but we've planned our supply chain incredibly well. We have the largest supply chain in the world. Our partners, TSMC, our memory partners, SK Hynix, Micron, Samsung, are doing a fantastic job supporting us. And all of our systems partners, Foxconn and Quanta and Wistron our packaging partners. Everybody's doing a fantastic job supporting us. And we've done a good job planning for a very, very strong year. And we've done a good job planning for Vera Rubin. So sales are off the charts. Nvidia GPUs in the cloud is sold out, but we've got a bunch of Blackwells to sell.
Jensen, what's the road ahead for Vera Rubin? It's one of the most common questions we get for you of how that ramp will go relative to what we saw with the Blackwell generations.
Well, the silicon for Vera Rubin, 7 different chips are back in our labs. And the bring up is happening across engineering teams. Probably a couple of 20,000 people are working on bringing up Vera Rubin, from silicon to systems to software to algorithms. People are working around the clock, and this bring up is going beautifully. We're on track to deliver Vera Rubin about Q3 timeframe of next year, continuing our once a year cycle. Vera Rubin is already assured a huge success. Everybody's incredibly excited about it. Can't wait to show everybody. And then one last thing is that the rack architecture, the rack scale architecture is completely revolutionary. It includes a scale up switch called the NVLink. NVLink 72, our 5th generation, is the only one of its kind in the world. This rack architecture, which is incredibly complex, started with Grace Blackwell, then Grace Blackwell Ultra. It is transition to Grace Blackwell Ultra is incredibly seamless. The same rack scale architecture is going to be used for Vera Rubin. And so the supply chain is all used to it. This complexity that we enjoyed with Grace Blackwell transition, we're now incredibly smooth running. And so I think Vera Rubin's going to be just really smooth, and we're going to ramp it really hard.
Jensen, I tried to go through what the CFO Colette Kress said about China. In the quarter gone, it seemed like there was not meaningful H20 sales because the demand wasn't there, even if you were permitted to sell H20. And then in the current period and going forward, Nvidia seems committed to working with both the United States and China to sell what Colette called more competitive compute. Where do we stand with that? And could you just clarify what Colette was talking about in the current state of play for China?
The most important thing she said is that we've said for some time now, our forecast for China is 0. All of our forecast, the guidance that we showed, 0. We should start. That's the most important thing that she said. She also said that effectively China is a very important market to us. It's very important to the United States. It's very important to China. We would love the opportunity to be able to re-engage the Chinese market with excellent products that we deliver and to be able to compete globally. The Chinese market is very large. This year, my guess is probably about $50 billion. It's great for the American people that we're able to compete in the Chinese market. It's great for the China market that we're able to provide NVIDIA's technology to them. It's great for the rest of the world as Chinese software companies and Chinese open source models leave China and are used all over the world. And so I think it's fantastic that it would be fantastic if we're able to participate in the China market. But for now, we should just assume our NVIDIA's forecast for China market is 0. We're going to continue to engage the US government, continue to engage the China government to advise them and to encourage them to allow us to go back and compete in the open market. And so until then, we should assume 0.
Jensen, we can see where the hyperscalers are getting the money where they have the money to deploy and build. But you mentioned Anthropic. With Anthropic or indeed OpenAI, they have tens of billions of dollars of commitments around the world. Very simple, like how do you know that OpenAI is good for it, that it will be able to find the money?
Well, we're thoughtful, along with OpenAI, thoughtful in aligning on and taking into consideration visibility of demand and their financing capabilities. All of that has to be in accordance, has to be aligned, has to be coherent before we start to build out. And so I think the ambition's large, but the execution is disciplined. And that's really, really important to recognize. We're very disciplined with our investment. We're disciplined with our build out. These are very large scale investments. And so the two teams are quite disciplined, very disciplined in thinking through the investment levels. Now, it's also important to take a step back and realize that OpenAI, Anthropic, these are the fastest growing company in the history of humanity. Their offtake, their end market demand is absolutely real and absolutely incredible. And you could see that they're really struggling to keep up with the demand that they have. The engineering teams, we work incredibly hard to make sure that we bring them on more capacity, but also optimizing their stack so that the usage of whatever capacity is as efficient as possible. And meanwhile, there's so many new use cases that they want to put out into the world, and is currently limited by the capacity they have. And so this is a really important time. You're seeing an exponential growth in the amount of compute demand necessary for AI. You're seeing an exponential growth of adoption and use of AI, and the number of applications that are going to be using these AI is also growing. And so we've got to do our best to support the scaling out of two of the most consequential companies in history, and we're delighted to be partnered with them.
Jensen, investors have been worrying about depreciation. Software can actually extend life. Like, there are A100s out there in the real world still at full utilization. Are people underestimating how long your chips stay useful, or are they kind of misunderstanding in the context of depreciation how you're handling generation to generation updates of GPU?
Nvidia is unlike any other accelerator. And the reason for that is because of CUDA's diversity of capability and versatility. Remember, I said two things earlier. I said that the fact that Nvidia participates and could accelerate every phase of AI, pre-training, post-training, and inference. We're the only architecture in the world that does that fantastically. The second thing we do is we run every single model. And so most agentic systems, most clouds are running so many different diverse type of models, language models, vision models, biological models, chemical models, for all the different fields of science. Nvidia could be used across the entire lifespan of the technology. And so if you look at products that we shipped, Ampere A100, we shipped 6 years ago. But because we're continuing, our install base is so large, our diversity is so great, we could continuously update our software, bring value to our customers on the one hand, but because our versatility is so great, based on the capability they need, they could use our GPUs for a very, very long time. Now remember, A100 is 6 years old. However, it is still an order of a magnitude faster than any CPU could put to bear. So it is still the best computer. It is still the best processor for much of the workload in the cloud. And most people misunderstand that because unlike us, most accelerators are kind of singular use. Because they don't have diversity, because they don't have versatility, because they're not great at every phase of AI, once they're used for whatever they were designed to do, their value falls off a cliff. That is not true with Nvidia.
Nvidia CEO Jensen Huang speaking exclusively to Bloomberg Tech anchor Ed Ludlow. And here at the Bloomberg New Economy Forum today, former UK Prime Minister Rishi Sunak has been sharing his views on the global AI race.
Now, when it comes to the AI race, there is all this focus on the race to AGI. Who's going to get to the singularity? Is it the US? Is it China? I actually think that's actually the wrong race to focus on.
Okay.
And I actually think the race we should probably pay a little bit more attention to is the race for who can adopt technology and AI in particular the fastest.
Joining us now is Bloomberg's Chief Asia Correspondent, Rosalind Matheson. And Ross, take us through some of the key themes coming out of discussions today on AI.
It was interesting, as you say, to have Rishi Sunak asked about the race, and he was asked about generative AI, and he said, actually, more important is the race to get AI and technology infused into your economy, to get it out into society. And whoever gets there first wins. Interestingly, he didn't name a country, but of course, we know some countries that are making a lot of progress, including China, on that. But he said that's the mark of success on AI. And obviously, when he was Prime Minister, he was pushing heavily for AI to be a prominent thing for the UK. He says that he's on the innovation end of it. So as a government official, you know, you don't want to over-regulate AI. You don't want to get in the way of it being able to evolve quite quickly. But interestingly, he also talked about his sense of fear. He talked about fear in the West compared to places like China, India, the Middle East. He said there's a real palpable sense of worry about AI in the West. And it's not just about jobs and whether AI takes your jobs. It's more pervasive than that, and a real role for governments and companies as well to try and reassure people in those parts of the world. But interestingly, he was drawing that difference between, you know, West and East, essentially.
As you said, he didn't name a country, but it does seem like he is suggesting China will win the AI race. And today we just had news out of the US suggesting perhaps, you know, the Congress will allow Nvidia to sell its chips to China.
Well, that's right, and it's possibly because of Jensen Huang's lobbying of Donald Trump having paid off. And this would obviously be for Nvidia, but also for companies like AMD, who right now, you know, they're struggling with the idea of selling their best stuff into China. Do they have to essentially keep it for the US market? And the idea that, you know, Donald Trump or the White House is urging Congress not to do that and to allow them essentially, again, to sell those kinds of chips into the China market. And does that give China yet another advantage in the tech space? So you can see, therefore, a bit of tension perhaps between what Donald Trump is thinking based on his own, you know, relationship, you would say, with Nvidia as well, but also his very business-like attitude to being the president versus maybe what some in Congress want or are concerned about.
Of course, it is not a zero-sum game. Both the US and China can have great access to AI and maybe coexist in that sense.
Well, that's right. I mean, in theory, people say a rising tide lifts all boats and everybody can benefit from AI. And certainly we've seen some of the speakers at the New Economy Forum today talking about that. Also the risks from AI, but the positive globally. But again, a lot of the conversation here has been about the bifurcation between China and the US, in the sense that we're in a truce now on trade and things are on a bit of a more even keel, but fundamentally you've got two very big countries with very different priorities and agendas in the long term. And structurally, you know, a lot of tension there, and that's not going to go away. Certainly things are a bit calmer for now, including on the trade front, but there is that fundamental competition. And all the speakers we've had, including the Singapore Prime Minister in his comments last night, was saying, you know, structurally, that kind of great power competition is not going to dissipate.
And the thing is, for him, the only thing that can deter China or stop China is China itself. But apart from that, we have the Indian minister weighing in as well, you know, talking about how India wants to be part of this, you know, chip race, AI space. He talked about T3.
Well, that's right. So India, of course, being a very, you know, growth market in terms of tech and chips being really seen as a critical industry for a lot of countries, a lot of companies. But then comes the question, if everybody is wanting to protect and reshore in a way around these critical sectors, pharmaceuticals, chips, obviously rare earths being a key priority, if you're trying to keep all that at your home market, then everybody's bringing it back. But who's actually going to be doing this stuff on an international basis? And so, you know, that just brings, you know, even further questions around the resilience of reshoring and who's doing what. But India certainly, you know, a dynamic population, a growth economy, and very much innovating in the tech space. But India also, for now, very reliant on China when it comes to technology as well, as many other countries are.
Yeah, a long way to go. Thanks, Ross. Thank you so much for that, Bloomberg's Rosalind Matheson there. Now still ahead on Inside. Singapore's Prime Minister says fierce competition between the US and China will persist, as Ross said, despite the recent trade truce. Our conversation with Lawrence Wong coming right up. Keep it here with us. This is Bloomberg. Singapore Prime Minister Lawrence Wong says fierce competition between the US and China will persist despite the recent trade truce. Speaking here at the New Economy Forum, Wong told us the recent leaders' summit created a much-needed temporary stabilization in the relationship.
I visit China regularly just to find out how things are developing. And all the actions that America takes vis-a-vis China has, in a way, only strengthened their resolve to work even harder, to move faster on technology self-sufficiency, and they are determined to grow. So one China commentator tells me there's nothing America can do to stop China. Only China can stop China. And when I heard that, it reminded me of something I heard a long time ago about the US too. There's, Abraham Lincoln once said, if destruction be our lot, let us, Americans, be the author and finisher of it.
When we talked about the region, you said you didn't think there was the war coming on or anything like that. But there is. Do you think in the end, a country like Singapore will have to choose between China and America? You've managed to avoid that so far.
Yeah, another favorite question.
Yes, it's coming that way. Journalists are notoriously unoriginal, but the problems don't change. No, the choice is arguably getting bigger.
The pressures will always be there. The great powers say we don't want you to choose, but of course each one wants us to be a closer friend to them. And that's always, the tension is always there, the pressures will always be there, but at the end of the day, we don't have to choose, really. We have to, it's not issue by issue. There will be some instances where we look at the issue, and we so happens that the particular position we take is the same as the US, for example, or as China, for example. But it's not from the lens of choosing one versus the other. It's from the lens of Singapore's national interest. And that will always be the case for us. And it's the same, not just for Singapore, it's the same in ASEAN. ASEAN countries feel the same way. We have been the arena for proxy wars before. It's been such a painful experience. We don't want that to happen again. And so ASEAN will continue to be fiercely independent.
But when Xi Jinping and Donald Trump met in South Korea, you called it a temporary truce. And I wonder, you've just seen this spat going on between Japan and China over Taiwan. How precarious does Asia feel at the moment?
I thought, first of all, going back to the meeting between the two leaders, President Xi and President Trump, it was a good meeting. And while it may be a temporary truce, a temporary stabilization in the relationship, it's much needed. And it will provide guardrails for the two powers to engage one another. It will open up channels of communication. It's not just once off, because the two leaders will meet probably 4 times next year, because President Trump has said he would visit China, President Xi will probably visit back, and then there's APEC in Shenzhen and G20 in Miami. So many opportunities for engagement, and it's much needed for stability. The intense competition and rivalry will continue, I'm sure. The mutual suspicion and distrust remains, but the guardrails will ensure that the rivalry does not slide into a full decoupling or worse, confrontation and conflict. So on that, I'm slightly hopeful after seeing the rapport, the engagement that the two of them had.
Singapore's Prime Minister Lawrence Wong speaking to Bloomberg Editor-in-Chief John Micklethwaite. Now back live to the Bloomberg New Economy Forum now, where Senior Executive Editor Timothy O'Brien is leading a discussion on how the Trump administration's foreign policy priorities are impacting Asia.
In our own region, I'm talking about now in the Caribbean and the Eastern Pacific, that call into question our commitment to rules that have been in place for decades. And so, I do worry about that, and I do think it's possible that even future U.S. administrations, depending on how this plays out, may draw lessons that some of this actually works. And I think that's maybe the scariest thing of all.
And works in the context of disrupting the status quo?
Works in the context of actually extracting from partners and non-partners significant concessions that, at least in the near term, may be seen as benefiting the United States. If the rest of the world responded to the Trump trade approach by saying, we're just going to let you commit self-inflicted wounds and you're going to do whatever you want and we're going to continue to behave and operate as we were and not going to step forward with a bunch of concessions, that would have one lesson that it might impart on American policymakers. But when countries come forward and say, actually, we're willing to do this and that just to get off of this incredibly high tariff situation, I think, that will lead to different lessons, including by future administrations in the United States.
Just a reminder that we can take questions from the audience if you have them. I'll see them on my iPad and dutifully try to get to some of them. Tammy, how does China view the Trump administration? And do you think they have clarity on how best to secure China's own interests in the Trump era? Or do you think they're off balance themselves?
Well, I'm very glad that John just mentioned that when you talk about, we are not asking the Asian countries to pick sides. I presumably you mean the administration, right? Whoever is the president. I think this is, for China, as I just mentioned, China is part of Asia. It is here. And China is with all these neighbors, all these Asian countries, and China now is the world's second largest economy, unavoidably, and China is growing. And China has very close trade ties, and everything with all these neighbors. They must work together. This is the reality. And then the U.S. is the superpower. So Asian countries, for all the reasons, they must handle this too. But I think for China, whether China is well prepared in dealing with President Trump, especially President Trump's 2.0, I think now China is much better prepared comparing with Trump 1.0. The thing is, I do believe Beijing leadership, whoever who is sitting in the White House, Beijing still wants to maintain relatively peaceful relations with the U.S. I think President Trump, a couple of years ago, when he met President Biden, he mentioned China-U.S. relationship cannot be, it's impossible for China-U.S. relationship to go back to what it used to be.
And that is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.